Hi everyone, I'm Paul and welcome to my ICT concepts video on fair value gaps and how to use them. This is my third video on fair value gaps, and in this video we're going to be focusing more on the concepts behind fair value gaps and how to actually use them. I'll still be covering what a fair value gap is in this video, but if you're looking for a more detailed or a more step-by-step explanation, then I'll put the link for the other two videos in the description so you can watch them first. But if you're looking for a more conceptual understanding of fair value gaps and how to use them, then this is the video for you. But before we jump into today's video, there's something you should know. I work really hard at putting these videos together for you, and I know that they create a lot of value. But you need to understand that these videos aren't free. Now the great news is you don't actually have to pay with any money. All you need to do is subscribe to my channel if you haven't already and give this video a like. That's it. Let's call this our gentleman's agreement or our lady's understanding. This is going to be our social contract because I can't look over your shoulder and make sure that you're doing it. I just have to trust that you will. So in exchange, I'll keep making high quality, high value videos for you all you need to do is keep liking and subscribing. Which sounds like a pretty good deal to me. And besides, everyone's doing it, and so you should too. Lastly, if you'd like to hear more from me and join a community of like-minded traders, then check out the link in the description where you can subscribe to my free weekly newsletter and to join our Discord. Now that that's out of the way, let's jump into today's video. Today's ICT concepts video is on fair value gaps. And we'll just quickly run through a brief outline of what we're going to be covering in today's video. So first of all, we're going to be looking at PD arrays and the fair value gap. Then we're going to go into what actually is a fair value gap, followed up by the concepts behind using a fair value gap. And then finally, we're going to finish with how you should use fair value gaps, along with some practical examples to help consolidate our understanding. We'll start today's video by discussing PD arrays and the fair value gap. So if we look at our dealing range, and our dealing range is split between equilibrium, so above 50%, and below 50%. So above 50%, we have our premium part of the range, and below equilibrium, we have our discount part of the range. And so if we're looking at fair value gaps in our premium part of the range, these will be bearish fair value gaps, and in our discount part of the range, these will be bullish fair value gaps. In this next part of the video, we're going to be going through what is a fair value gap. Now, I've got two other videos which go through fair value gaps in a lot of detail and step-by-step explanations. So if you'd like something that's got a bit more information in it and is going a little bit slower, then make sure you check out those two videos. I'll put links for them in the description. But if you're already familiar with fair value gaps, this will just act as a quick revision. So if we look to the illustration on our slide, you can see we have price trending up towards a high time frame point of interest. We get price dig into that high time frame point of interest before pulling back, so we get a strong displacement away from that high time frame point of interest. That gives us our bearish market structure shift. Price trades back up into that displacement zone before trading lower. So it's in this actual displacement away from our high time frame point of interest that we're going to be looking for our bearish fair value gap. Now, a bearish fair value gap is our 3 candle formation, so 1, 2, 3 candles, and the fair value gap is located between the low of that first candle and the high of that third candle. And so what we'd be looking for is the bearish fair value gap in this displacement range, and the key criteria of our fair value gap being a valid setup is we get a strong displacement away from this high time frame point of interest, we get our market structure shift which is bearish, and then price trades back up into the fair value gap, so back into this zone between the low of the first candle and the high of that third candle before trading lower. Now, the concept we're going to introduce in this video is consequent encroachment, which is the midpoint of the bearish fair value gap. And so you can see in the body of this second candle here, we have our midpoint or our 50% level, which is our consequent encroachment. So moving on to our bullish fair value gap now, and it's obviously essentially the same as our bearish fair value gap, just in reverse. So we have price trading down towards a high time frame point of interest. We get a displacement, a strong displacement away from that high time frame point of interest, which gives us our bullish market structure shift. We have price trade back into that displacement range before going higher. Now, it's in this displacement range that we're going to be looking for our bullish fair value gap, which again is our 3 candle formation. So 1, 2, 3 candles, and the bullish fair value gap is found between the high of the first candle and the low of the third candle. And so once again, for our fair value gap to be a viable setup, we want to see a strong displacement away from that high time frame point of interest. So this generates the fair value gap. We get our market structure shift, and then price trades back into our fair value gap. So it trades between the high of the first candle and the low of the third candle before price then reacts to that and trades higher. And so once again, we have consequent encroachment, which is a new concept, and that's the midpoint of the bullish fair value gap. So you can see here on the body of that second candle, our consequent encroachment is the midpoint or the 50% level of that fair value gap. So now that we know what a fair value gap is, it's important that we understand what the concept behind a fair value gap is so that we can better apply it to our trading. So we'll start with our bearish fair value gap. And so again, we have our price trading towards a high time frame point of interest. We get our displacement away from that high time frame point of interest, which is where we're going to find our bearish fair value gap. Now, a bearish fair value gap is a range in price delivery where the sell side liquidity is delivered and there's no buy side. So you'll often hear this referred to as a SIBI, so a sell side imbalance, buy side inefficiency. And so all that means that there's only sell side being delivered, there's no buy side. And so you'll recall this is the same underlying concept that we covered in the liquidity void video. And so just like with our liquidity voids, it's the same market participant that is actually behind the SIBI that we're interested in. So we have smart money that is responsible for this strong displacement away from this high time frame point of interest. So remember, it's only smart money that has the firepower, if you want to call it that, to push price around in this kind of manner. And so they're the ones who have generated this SIBI. So whenever they're in the market, we obviously want to take notice. And so just like with a liquidity void, this inefficiency or this imbalance, we'd expect that it's going to be rebalanced at some point. And so that's why price is expected to come back into this area before it then continues to trade lower. And so just an additional point on our consequent encroachment, the reason why this is important is this is often the area where price will react to, because this consequent encroachment level or this midpoint is very sensitive. And so moving on to our bullish fair value gap, the concept behind it is the same. So we have price trading down towards a high time frame point of interest. We get our displacement away from that high time frame point of interest, and that's where our bullish fair value gap is going to be formed. So in this case, our fair value gap is a range in price delivery where only the buy side liquidity is being delivered and there's no sell side. And so we call this a BISI, so a buy side imbalance, a sell side inefficiency. And so once again, this is the breadcrumb or the trail that we have to know that smart money is in the market. So we can tell that this high time frame point of interest is important. We can see that price moves strongly away from that. So we know that smart money is in play. And again, with our BISI, we know that this inefficiency will be filled at some point. And we expect price to come back into that zone, react and fill in that inefficiency before trading higher. So once again, our consequent encroachment level is our midpoint in this displacement range, so in the fair value gap, and price will react often to that midpoint or that 50% level. So now that we know what a fair value gap is and we understand the concepts behind fair value gaps, we get to the bit that everyone wants to get to, which is how do we actually use a fair value gap in our trading. So we're going to start with our bearish fair value gap example, and we're just going to use the same illustration we've been using throughout the video. So we have price trading up towards our high time frame point of interest. We have our bearish fair value gap, which has been formed in the displacement leg. We get our market structure shift, and we get price trade back into the bearish fair value gap or into our SIBI. And so how would we use this particular setup or this framework to enter our trade? And so in this example, what we've done is we've used the 3 candle formation, so our bearish fair value gap, and we're going to use the consequent encroachment, so the 50% level, as our limit sell order. So we're obviously going short because this is a bearish fair value gap setup. So we'll use our consequent encroachment level as our limit sell, and we're going to use our stop as the high of that first candle. And so in terms of how we can do this, there's lots of options. You could use the high of the third candle as your limit. We've used the consequent encroachment in this example, but you can use anything inside the fair value gap as your limit sell order. You can obviously use a limit sell order, or you could even just place an order at market once price goes into this area. It's really up to you, and it just comes down to your testing in terms of what works best for you. In terms of stop placement, I always like to use this high of the first candle. I think that's the safest, and that generally will coincide with the swing high, which has taken out that high time frame point of interest. And if you wanted a tighter stop, you could always use the high of this second candle just here. And it also depends on how these candles are formed. So sometimes you'll actually have the high of the second candle higher than the first one. And so, you obviously just have to adapt to what the market's giving you. So that's how we would enter and how we would put our stop in for our risk management. And so the question is, well, where would we start to look at taking our profits? So one of the easiest things to do is always look for our low-hanging fruit. And so the leg that you would look at is the displacement leg that breaks market structure, or potentially one of the swings that happens before we take out that high time frame point of interest. So this is always a good place to take that first take profit. So that's that low-hanging fruit that ICT always talks about. And it's generally at this level that I'll roll my stop to break even and then let the rest run to my TP2. And so your TP2, or your final take profit, will just depend on how you frame the trade. So for me, it generally comes down to where the origin of the move has come from, or it might be at the bottom of the dealing range. So it's really up to you. And obviously you can use other PD arrays, which would be in a discount part of the range as your exit as well. Moving on to our bullish fair value gap example. So again, we have price trading down towards our high time frame point of interest. We get our displacement away from that high time frame point of interest, which gives us our bullish fair value gap in this displacement leg. We have our market structure shift, price trades back into our fair value gap before trading higher. Now in this example, again, we have our limit buy order set at that consequent encroachment level, that 50% or midpoint of that second candle. But again, you can have the limit buy order anywhere. You could have it at the low of this third candle, or you could go in at market anywhere in that fair value gap range between the high and the low of those candles. Again, our stop placement, the one that I prefer is the low of this first candle, which will generally coincide with the swing low, which has taken out this high time frame point of interest. I find this to be the safest stop to use, but if you wanted to be more aggressive, you could use the low of the second candle. And again, it comes down to how these candles form. Sometimes this second candle will actually be lower than the low of that first candle. So you have to use your discretion. And again, it always comes down to your trading preference or your style and what you've back tested. And then moving on to our take profits. So again, I'm always focused on what my first take profit is, because that's the low-hanging fruit. That's going to be the easiest trade to achieve, and that's the one that I'm going to use to make sure that I pay myself off any successful setups. So for me, I always look at the swing high of the displacement leg, or one of the earlier swing highs which led up to the eventual move which took out that high time frame point of interest. So these tend to be the easiest ones to achieve, and once price has reached that point, that's where I'll generally roll my stop to break even, or a little bit better, just to help cover costs, and then let the rest run to my final take profit, or my TP2, which is generally going to be at the origin of the move or the top of the dealing range, which I've used to help frame my trade. And finally, to finish up today's video, we're going to go through some practical examples using fair value gaps. The first example we're going to look at is a bearish fair value gap on the S&P 500 or the E-mini S&P. So you can see we're looking at the 3-minute chart here, and I've marked out my dealing range from this swing low to this swing high, and you can see that prices come from a discount into a premium. We've taken out this buy side liquidity on this big spike here. Prices continue to trade higher before it breaks down. You can see as it starts to break down here, we get a displacement. It's not a big displacement, but it's a displacement nonetheless. And that gives us our market structure shift here, and price trades back into the fair value gap that was formed. So our fair value gap is here. So our 1, 2, 3 candle formation, and our bearish fair value gap is formed between the low of that first candle and the high of that third candle. So you can see just here, price trades back into that fair value gap before trading away. Now in this example, I've just used my limit sell order from the high of that third candle, just because the fair value gap is quite narrow. There's no point sort of looking at consequent encroachment or anything like that. And in terms of my stop, I've just used the high of this first candle. Now in this example, I've used the high of this first candle because price has already started to break down after taking out that buy side liquidity. If this was closer to that initial sweep of the buy side liquidity, I'd look at using the swing high higher, just because that is going to be a safer entry and give me a little bit more buffer on my entry. In this example, you can see once we touch into it, the market just drops away and goes straight down towards equilibrium. And so my take profit in this example, I used the swing low just here at equilibrium because that was the one that made the most sense. We didn't really get a big displacement leg after that fair value gap, or whilst that fair value gap was being formed. So the swing low there obviously wasn't available. And so in this instance, I've looked towards equilibrium as my first TP. You can see price is just traded almost directly to that. So in this example, once we hit that TP1, I would roll my stop to break even. So I'd roll the stop to about this level, maybe a little bit more, just to cover any costs. You can see that price then consolidates around this equilibrium level, around this swing low, before just immediately dropping. It's even gaps as it drops down towards the end of this dealing range. And in this example, I've used my TP, or my final take profit, at this swing low here, which is in our discount part of the range. And so in this example, you can see my first, partial would have given a 2.8R return, so that's quite good. And then obviously the final TP2 would have given a 5.8R return. So obviously this just comes down to how you prefer to trade. For myself, I always want to pay myself first. So this guarantees that from a successful setup, I'm always walking away with some money. But if you wanted to trade all the way to, this TP2 or your terminus, then you would have picked up a 5.8R return of this trade, which is obviously fantastic. The next trade we're going to look at is a bullish fair value gap, but this time on Bitcoin, but again on the 3-minute chart. So in this example, you can see I have my dealing range from this swing high to this swing low here, and you can see price comes from a premium into a discount. We take out this sell side liquidity, this high time frame point of interest here, and then price immediately spikes back through that. So ICT often talks about this being a discount within a discount. So we take out the sell side liquidity again. You can see in this example, we get a strong displacement once we get that second sweep of liquidity. So the price displaces upwards here. You can see we get our market structure shift on this move. And in the displacement leg, you can see we have our bullish fair value gap just here in blue. So price trades back down into that level. Now in this example, we're using consequent encroachment. So we're using that midpoint, or that 50% level of the fair value gap, as our limit buy order. So you can see that's our limit buy order just here. And in this example for my stop, I've used the low of that first candle, but again, you could use the swing low if you wanted to give yourself a little bit extra buffer. Now, as we can see, price consolidates here for a little bit before trading up towards equilibrium. So in this example, for my first take profit, I've just looked at below equilibrium, so a little bit more of a conservative first exit, and I'm looking at the imbalance that's just here on this candle. So the actual midpoint of that candle is where I'm taking my first take profit. So you can see price trades up towards that. And then once price has traded up to that level, I'll then roll my stop to break even, to lock in that profit, make sure I pay myself, and then let the rest run. So similarly to the last setup, you can see that price just gravitates around that equilibrium level before making a final push up towards TP2. Now in this example, this is the origin of the move. So you can see this is where price broke down. So we're trading right back towards the origin of the move. So that's our TP2, or our terminus. So once again, if you'd just chosen to enter on this trade and exit at the origin of the move, that would have given you a risk return of 4.28, which is obviously a great result. But if you looked at taking partials, you would have got 2.42 on that first trade, and then obviously 4.28 on the balance. Thanks for watching my ICT concepts video on fair value gaps and how to use them. I hope you found this video helpful, and hopefully you can incorporate fair value gaps into your trading and your analysis. Don't forget our gentleman's agreement or our ladies' understanding. I've done my part and now it's time for you to do yours. Lastly, if you'd like to hear more from me and join a community of like-minded traders, then check out the link in the description where you can subscribe to my free weekly newsletter and to join our Discord. Thanks for watching, and I hope to see you next time.